Good morning, everyone, and thank you for joining us. You are attending the DBRS Morningstar webinar on the U.S. Consumer ABS 2022 Outlook. My name is Stephanie Ma. I'm a researcher in our Structured Finance group, and I will serve as your moderator today. I am joined by my colleagues, all SVPs from our U.S. ABS group, Ines Beato, John Reber, and Imran Ansari. First, we will start out with a broad overview of the state of the U.S. consumer, and then we'll dovetail into specific consumer ABS sectors, namely autos, credit cards, student loans, and marketplace lending. A couple housekeeping items first. Please feel free to type in any questions that you may have throughout the presentation. You should see a question mark either on the right side or the bottom of your panel. You can click and type in your questions. We will address your questions at the end of the webinar. And you should also see at the bottom of your screen a referenced research note titled U.S. Consumer ABS 2022 Outlook, which was published last month that you can also review on the topic. Before we jump into the various ABS sectors, we thought it would be helpful to set the stage a bit and discuss the current state of the consumer. The U.S. consumer is on relatively better footing as we progress further into 2022. The unemployment rate has been declining since April of 2020 and fell to just below 4% at the end of last year, approaching the 3.5% pre-pandemic rate. In addition, according to the U.S. Department of Labor, seasonally unadjusted weekly jobless claims were 238,000 for the week ending January 29, and this is down sharply from the weekly high of approximately 6 million in April of 2020. Federal stimulus measures, combined with forbearance programs and moratoriums on home foreclosures and rental evictions, provided significant aid to borrowers in the consumer ABS sector. Many consumers use the extension of unemployment benefits to reduce their outstanding debts and increase savings. According to an Oxford economic study released last summer, Americans added nearly $4 trillion to their savings during the pandemic. And indeed, the personal savings rate actually peaked at 34% in April of 2020, followed by 25% in May. And this compares if over time, over the past decade, the average historical savings rate was roughly about 8%. Nonetheless, the state of U.S. consumer finances remains uncertain with the expiration of federal unemployment and pandemic benefits last year, and as consumer debt levels reach new heights. In addition, the Omicron variant and other possible future variants could dampen the momentum from last year's economic recovery. According to data released just yesterday by the Fed, consumer debt grew by more than $1 trillion in the span of a year, totaling $15.6 trillion at the end of last year, compared with $14.6 trillion at the end of 2020. I'm sure many of you may have read this morning's Wall Street Journal article on it. The headline, Americans took on more new debt in 2021 than in any year since before the 2008 to 2009 financial crisis. The increase has been primarily attributed to a sharp rise in prices for both homes and cars. The article cited that the average US home price rose close to 20% in 2021. And meanwhile, rising prices for new and used cars also drove auto loan originations to a record 734 billion. Nonetheless, the rise in consumer borrowing isn't cause for alarm. According to New York Fed economists, they state that wealth has increased across all income levels during the pandemic, and delinquency levels on consumer loans are still hovering around record lows. In this slide, you can see that delinquency rates by product continue to decline, but more importantly, new transitions into delinquency mostly declined across the board, continuing to reflect various borrower assistance programs available. The share of student loans that are reported as delinquent remains very low, as the majority of outstanding federal student loans are covered by the federal government administrative forbearances. Auto loans and credit cards also showed continued declines in their delinquency transition rates, reflecting the impact of government stimulus programs and bank-offered forbearance options for troubled borrowers. When examining 90-day plus delinquency rates across products at the end of last year, the auto loan delinquency rate was around 4%, coming in below credit cards at 8.3% and student loans 5%. But again, keeping in mind forbearances. With that backdrop in mind, let's turn our attention to the consumer ABS sectors. Let's start out with autos. Ines, what is our outlook across prime and near subprime autos?
Thanks, Stephanie. So ABS issuance is highly correlated to vehicle sales and auto loan originations. While new vehicle sales have been affected by inventory shortages attributable to factory closures and chip shortages, as well as high vehicle prices, this has shifted some demand to used vehicles. Although used vehicle sales are lower on a year-over-year basis, the decrease has only been about 4%, as estimated by December used SAR, which was 39.1 million in December of 2021, down from 40.6 million in 2020. The strong demand in vehicle sales has been bolstered by stimulus check payments coupled with pent-up demand for vehicles as people continue with apprehension in resuming public transportation and have sought alternative forms of travel. We expect the continued demand for vehicles to support ABS issuance in 2022 at near to slightly lower issuance volumes in 2021. While auto loan collateral performance has fared better than initially expected throughout the coronavirus pandemic, we expect 2022 will likely bring a reversion to pre-pandemic levels, with some deterioration in performance expected as government stimulus has largely phased out. As Stephanie mentioned, the unprecedented level of government stimulus and expanded unemployment benefits, coupled with moratoriums on foreclosures, provided many obligors with additional cash. That, coupled with restrictions on entertainment, travel, and dining, allowed many households to reprioritize their debt payments, where obligors were able to pay down debt and build up savings, attributing to the strong performance. As government support has completely or almost completely phased out in 2022, obligors will be under additional cash flow pressure, and therefore we expect to see some weakening in performance. As it relates to rating performance for the sector, we are expecting ratings to remain stable this year.
Great. Let's delve a bit deeper into the details, Ines. I know at the onset of the pandemic, many market participants were bracing themselves for a deterioration in credit. What have you seen over the past year in terms of auto loan delinquencies, and what are your expectations for this year?
So as mentioned, performance post-March 2020 and early 21 was very strong as delinquencies and defaults remained low since the beginning of the coronavirus pandemic. Delinquencies in early 2020, as shown on this graph, were at highest levels since 2017. Then in March and April, we observed a sharp drop. The use of extensions, which we'll talk about on the next slide, attributed to this initial drop. However, delinquencies for both prime and subprime continued to drop further into 2020 and early 21, offset by some of the credit tightening by some lenders in late 2019 and early 2020, and then further tightening in response to the pandemic, coupled with the reasons mentioned before that supported obligor cash positions. However, in late 21, we can observe a start of a reversion as delinquencies have begun increasing. This is due in part to seasonality trends, where we traditionally see increases at the tail end of the calendar year, which then generally normalize from February to May as obligors pay down debts with tax refund money. Given reports that 2022 tax refunds may be delayed, we'll be monitoring that for possible impact. On the next slide, we can see extension performance. At the onset of the pandemic, extensions spiked quickly as obligors were faced with the unknown and requested hardship extensions as they navigated stay-in-place orders and possible unemployment. Extensions are an effective loss mitigation tool used by lenders to work with obligors during life events, hardships, and environmental events such as hurricanes. Despite the initial spikes, as obligors received stimulus checks and returned to work, many made payments and returned to current status pretty quickly. Extensions quickly returned to more normal levels. And similar to delinquencies, extensions have started to increase over recent months, but still remain below pandemic levels. As you can see, 2021, we have as far as November, and it still fares pretty well compared to the year prior. Used vehicle values have also driven by lower supply coupled with higher demand, are about 66% higher than they were pre-pandemic values, according to the Manheim Used Vehicle Value Index. This has translated into strong recovery rates for ABS transactions, supporting the better than expected performance even upon a default. In 2022, we expect to continue to see higher than usual recoveries as we expect used vehicle values to remain elevated until supply normalizes. However, we do expect to see some stabilization in the values starting to begin. Although performance is showing signs of weakening, the deterioration is reverting back from recent lows and remains below 2018 and 2019 levels. Overall, in 2022, we expect there will likely be some continued deterioration in performance, reverting to more normal pre-pandemic levels.
Ines, with this expectation of deterioration in performance, what attributes in auto loan ABS structures might mitigate this deteriorating underlying collateral performance and support our expectation that ratings will remain stable?
So auto ABS structures are generally sequential pay, which allows for growth in credit enhancement, leading to increased loss coverage over the life of the transactions. Transactions generally include credit enhancement in the form of over-collateralization, which grows to a target over the life of the deal, incorporating additional collateral to pay off principal and interest on the notes. In addition, sequential pay structures allocate principal payments to more senior classes first, increasing subordination over time to each class. As the total credit enhancement grows as a percentage of the amortizing pool, the transactions are able to cover a larger multiple of losses. Auto ABS has been tested in various cycles and shown resilient ratings, even in circumstances of higher than expected losses, where the growth in credit enhancement has generally offset deterioration and higher than expected losses and attributes to rating migration history that includes mostly upgrades and confirmations. Despite the expectation of deterioration and a reversion to the normal, we expect that the structural mechanics in auto ABS transactions will protect ratings, although, depending on the level of deterioration, ratings on most subordinated bonds would be most at risk for any negative rating action.
Thank you, Ines. I know that we talked about kind of the increasing debt levels on autos. We've also seen this on the credit card side. Initially, at the onset of the pandemic, there was an initial pullback, not surprisingly, as kind of economies shut down and people were not using their credit cards. But in the last quarter, according to the Fed data, we saw that in the last quarter of last year, we saw that kind of revert back and we saw a spike in credit card debt. So let's shift gears a bit and talk about credit card ABS. Ines, what have you been seeing in this sector?
Well, similar to auto loans, government aid helped many pay down their credit card debt and build up their savings. So performance metrics for both retail and the top 6 bank credit card programs remained very strong in 2021, with 12-month average payment rates at 36.3% for retail cards and 20.8% for bank cards. Credit card ABS 30-plus day delinquencies were at 4.85% as of December 21, which has trickled up in recent months due to seasonal trends. However, they remain below 2017 levels. In addition, charge-offs remain below historical averages. In 2022, we expect performance is likely to revert to the mean as stimulus is fully phased out, coupled with the pent-up spending demand, which introduces further uncertainty regarding customers' ability to pay. In addition, if new variants affect business closures or sickness results in lost wages, coupled with inflation, obligors may need to borrow more against their cards, while their ability to pay may decrease. At $21 billion in issuance through December 2021, credit card ABS issuance volume has been robust, with the entrance of at least 5 new issuers and continued repeat issuers, which indicate healthy investor demand in 2022 and healthy spending. We expect ratings in the space to remain stable through 2022, despite our view that performance may weaken slightly.
Thanks very much, Ines, for sharing your views on autos and credit cards. Next, we'll hear from John Reber regarding student loans. For student loans, we look at ABS broken out across private, FFELP, and Refis. Let's briefly discuss our outlooks across all 3, and then we'll go into each subsector in more detail. John, take it away.
Thank you very much, Stephanie. So hopefully everyone can see this first slide. This first slide summarizes our view on the 3 types of student loans that we rate. Refi, Private In-School, and FFELP. It provides a snapshot of our transactions as it relates to our view of both pool risk and structural risk. So as you could see, there's nothing that we're concerned about currently. We feel that the refi sector is the strongest, and we have no material concerns with the in-school or FFELP bonds that we rate.
Great. Now let's dig a bit deeper into each. Let's start out with, I think we have refis up first.
Sure. So DBRS Morningstar has rated approximately 90 deals in the refi space since the sector's inception back in 2013. In 2021, total refi ABS issuance was about 7.2 billion. This was about 20% lower than the previous year. Refi volumes last year were somewhat held back due to the freeze on federal student loan payments under the CARES Act. Borrowers have not been required to make any interest or principal payments on federal direct loans, so there's minimal incentive for these borrowers to refi into a new loan. The freeze was supposed to end last month, but was extended by the administration to May. Based on conversations I've had with refi lenders, pent-up demand for refi loans could lead to volumes doubling or even tripling, and many of these new loans would soon make their way into securitization trusts. Refi deals have all performed exceptionally well, with losses much lower than expected, and we expect the same going forward. The earliest vintages, the 2013 through 2015 deals, which have mostly paid off, have experienced cumulative defaults of less than 40 basis points. And I would say as a whole, based on the close to 40 billion of refi transactions that DBRS has rated, charge-offs across the board stand at less than 50 basis points. We did see delinquencies decline significantly after the onset of the pandemic and into 2021 due to lenders placing borrowers into forbearances. And you could see this in the table top right on the slide. Starting in mid-2021, middle of last year, delinquency rates started to increase or essentially normalize. And this is primarily driven by borrowers exiting forbearances after multiple enrollments, with many lenders eliminating their COVID forbearance options altogether. That said, the sunsetting of this type of forbearance by lenders has also led to an increase in other types of economic hardship forbearance, but the amount is very small. While there may be some performance deterioration as borrowers cycle out of economic hardship forbearances, I don't see delinquencies and defaults increasing significantly in the refi space due to the high credit quality of refi borrowers and other positive attributes such as degree types and professions. The table on the bottom left here shows forbearances. The latest month of data that we have shows that overall forbearances were around 70 basis points in the refi sector. This is about half of what was reported in the first quarter of last year. So pretty big improvement, but like I mentioned, this is largely due to lenders eliminating their COVID forbearance options.
And John, what about on the private side? What are you seeing for private student loans, which include traditional in-school student loans?
Sure. So last year, total private student loan ABS issuance was more than 15 billion, which was actually about 3 times the amount of the previous year. And this was mainly driven by several deals that included Wells Fargo collateral. As many of you are aware, Wells Fargo exited the student loan business and sold their entire $10 billion portfolio to a consortium of investors, with all of the loans making their way into the ABS market last year. Prior to the sale, Wells Fargo held 100% of their loans on balance sheet. That said, I expect the private student loan ABS issuance for this year to decline back to a more typical level with the usual sponsors issuing deals. The performance tables here represent the vast majority of all public private student loan ABS outstanding. As you can see from this table, private student loans demonstrate higher levels of forbearances as compared to refi loans, in addition to a larger spike due to COVID when forbearances shot up from around 2% to more than 14% at the peak. Currently, forbearances have reverted back to just above pre-pandemic levels. The latest data that we have shows that forbearances stand at about 3%. As you could see from the delinquency table here, aggregate delinquency rates dropped markedly after COVID hit, and this primarily reflects an increased uptake of forbearances. The data we have shows that 60-plus day delinquencies stand at about 2%, which is almost a full point below where 60-plus day delinquencies were prior to COVID. That said, similar to refi loans, we've been seeing delinquencies creeping up over the past several months, with 30-day delinquencies showing the biggest increase. Nothing to worry about at this time, as delinquencies are still relatively low and look like they're just normalizing.
John, what are some of the attributes related to the collateral or deal structures in this sector that could help mitigate performance deterioration if, say, we go into another economic downturn?
Well, that's a good question. Many of the private student loan deals that we rate include very seasoned borrowers, with some loan pools that have borrowers that have a weighted average months in active repayment of more than 5 or even 10 years. Case in point, the Nelnet deals from last year that included all of the Wells Fargo loans that I just mentioned. Also, it's typical for Navient to include a large portion of legacy Sallie Mae signature loans in their deals. The signature loan program was replaced with the current Smart Option program more than 10 years ago. So we would expect that these deals may perform better than deals with newer collateral, all else being equal, as seasoned borrowers have proven their employability and their ability to repay their debts, in addition to being beyond the peak of the related default timing curve. Another thing to mention is that in recent years, lenders that sponsor private student loan securitizations have significantly strengthened their underwriting guidelines, in addition to stricter cosigner requirements and improved school and loan type quality. Lenders have incorporated more advanced underwriting approaches that are designed to better project the borrower's ability to repay their debt. Lenders have also increased the origination of student loans that require borrowers to make some payment while the student is in school. And we've seen that these loans have proven to perform significantly better than traditional student loans that are fully deferred while the student is in school.
And given these measures that you just mentioned, to help mitigate performance deterioration, on the flip side, what are some of your concerns in the sector that could affect performance?
That's another good question. I'd say that other than an unexpected resurgence of COVID or an economic downturn, I think right now inflation is a pretty big concern. Higher costs affect all borrowers' ability to repay their debts, especially if they're younger and don't have much disposable income. And the Fed's hawkish stance and the expectation for multiple rate hikes this year will likely result in variable rate loans becoming more expensive, obviously if wages don't keep up. I think the payment freeze on the federal direct loan program that I just mentioned earlier has benefited many private student loan borrowers, because it's common for private student loan borrowers to have a direct federal loan as well. So I think the elimination of the payment freeze on the federal program loans may make it harder for some private student loan borrowers to make payments as their total debt service amount will increase. Another thing I'd like to mention is that over the past few years, you could see it on this slide, we've seen a pretty significant increase in prepayment speeds. This is due to a number of things, including the strong economy before COVID, the government stimulus after COVID, borrowers that are paying off smaller loan balances, and of course the refi market. Also, a large portion of private student loan deals are very seasoned, so the underlying borrowers can better afford to pay off large chunks of their debts. Faster than expected prepayment speeds could add stress to certain securitization structures, because over time, there may be less excess spread available to cover losses or pay note holders. On the other hand, faster prepayment speeds can benefit deals as well in many cases. I just wanted to point out that the prepayment last year was the highest I've seen historically. The CPR was more than 14% at one point, although it has come down a bit since.
And this brings us to our last subsector, John, for student loans, FFELP student loan ABS. Please share what you're seeing on this side of the subsector.
Sure. In 2021, surprisingly, issuance almost doubled versus the year before and reached close to 10 billion. And this was mainly due to several state agencies or non-for-profits who collapsed old existing deals like 2011, 2012 vintages around that time and issued new bonds. This trend obviously won't last as there's only so many trusts that can be collapsed and a finite amount of FFELP collateral. That said, issuance volumes this year will likely revert back to more typical levels, with issuance declining over time, reflecting a dwindling amount of available collateral as FFELP was discontinued several years ago. FFELP deals have very little credit risk as they're ultimately backed by the US government. So nothing really to be concerned about at this point as far as credit risk is concerned. Some deals that we rate can actually withstand defaults of more than 90%. Actually, more defaults can add liquidity to a transaction due to the 97+% guarantee, and that helps pay down bonds faster. So that could actually be a positive for some investors, namely those that have legal final maturity or extension risk concerns. That said, the main concern with FFELP ABS performance over the past several years has centered around slower than expected repayment speeds. And this is mainly due to higher than expected income-based repayment levels. I would say that deals issued after 2016 or so have been structured with legal finals that are intentionally very long and include other structural features such as switching to full turbo after 10 or 15 years and the optional repurchase of loans out of the trust, sort of like an insurance policy or a belt and suspenders approach against extension risks. So I'm not really worried about these deals at all. I would say that deals issued before 2016, especially those that have fast approaching legal final maturity dates, say within the next 5 years, have a heightened level of risk. And those are the deals that we spend most of our time monitoring. Notes with longer legal final maturity dates have less risk because borrowers using forbearance or income-based repayment are more likely to resume normal payments or even possibly default, resulting in an increase in guarantee payments. That said, I feel that unless there is an unexpected increase or a spike in forbearances or income-based repayment rates for whatever reason, I don't think I have any significant concerns with FFELP bonds being paid their timely interest and their ultimate principal on or before their legal final maturity dates.
John, thank you for that very comprehensive overview for student loan ABS across private, refi, and FFELPs. Now we'll round out our discussion with NPLs. Imran Ansari, will you please walk us through our outlook and share our observed insights?
Absolutely. Thanks, Stephanie. Appreciate it. So while marketplace lending collateral has been resilient throughout the coronavirus pandemic, 2022 will likely bring some credit deterioration and reversion to pre-pandemic performance, mostly because, as government support for borrowers has largely faded. Nonetheless, we still expect that rating performance for the sector should remain stable this year. So when we think about some of the positives that are related to the NPL sector, as mentioned, NPL collateral has been resilient throughout the pandemic, largely benefiting from government stimulus measures, and also because platforms were very proactive in offering forbearance and deferment relief to borrowers. Marketplace lenders really demonstrate a strong commitment to working with distressed borrowers to slow the uptake in past due loans. Also, most NPL platforms use sophisticated machine learning algorithms and have strengthened their underwriting from the disruption caused by the pandemic, really increasing their ability to price risk more accurately in the future. Platforms have constant monitoring and the ability to quickly adjust underwriting cutoffs. Securitized pools that we've seen have remained consistently strong over time, with some NPLs reducing the term and overall risk of their pools. Further building on this, lenders that focus on super prime borrowers are not expected to be as negatively affected, as this consumer set typically have longer credit histories, higher incomes, and significant free cash flow.
Imran, what all these positives that you just mentioned related to the NPL sector, what about on the flip side, especially considering the absence of continued government support? What are your concerns going into this year?
Yeah, absolutely. It's a very good point. And some of the overhanging concerns related to the current environment and as NPL as a sector are that expiration of government support and significant policy response is likely to cause some borrower credit deterioration and reversion to pre-pandemic performance as borrower balance sheets are less flush with free cash flow. As a result, delinquencies have showed some volatility and an upward trajectory, especially from August 2021 onwards. We've seen a spike in 30-plus delinquencies that have exceeded about 2.5% at the end of last year. More specifically, platforms that focus on higher risk segments, including debt settlement and near-prime loans, are more likely to experience increased losses. This is because of these obligors' overall weaker credit profile and because this demographic was largely the main beneficiary of government stimulus. In addition, unsecured consumer loans are typically toward the bottom of borrowers' debt repayment hierarchy, below mortgages, auto loans, and they're likely to show deterioration in any stressed macroeconomic environment.
And Imran, continuing along those same lines, I know that there are certain structural features that we typically see in unsecured consumer ABS transactions that help to mitigate deteriorating underlying collateral. Can you please walk us through those?
Yeah, absolutely. So as Stephanie mentioned, unsecured consumer ABS structures have helped mitigate risk for note holders, that we've seen due to COVID-19, and they're expected to continue to do so. So unsecured consumer ABS transactions typically include structural features that help ensure that note holder principal is protected and that sufficient liquidity is available to pay note interest on a timely basis. These transactions are typically sequential pay structures, so no principal is allocated to subordinate notes until the senior-most class is paid in full. And, this feature provides substantial protection for senior note holders as no principal can be redirected to subordinate note holders. Unsecured consumer ABS transactions also commonly include collateral performance triggers. So if a trigger is breached, 100% of excess spread accelerates principal payments to the most senior outstanding class of notes, effectively cutting off any cash flow to residual holders. And this principal turbo feature provides significant protection to note holders because it results in higher credit enhancement levels and reduces the weighted average life of the note. Also, these transactions have fast deleveraging structures, which reduce the exposure to macroeconomic risk.
Thank you, Imran. This concludes our prepared remarks for the webinar. Now we will open up the discussion for Q&A. Again, you will see a question mark on the bottom of your panel or the right side. You can click on it, type out your question. I think I saw a handful come in. Let me just go through and see what we have. Okay. John, this question looks like it's for you. What are your thoughts on Navient paying $1.85 billion over claims it placed borrowers into predatory loans, costing repayment plans? What impact does this have on student loan ABS?
Sure, that's a good question. So we're still looking at this, but initial thoughts are that the settlement will not affect outstanding ABS deals materially. The loans that Navient will forgive are very seasoned and they've already defaulted and they've been charged off for many years. Further, I don't think there's a material amount or any type of concentration of these loans in any of the Navient or NAVSL securitization trusts that we rate. So for any loans in the trust, the impact would be minimal, as the only impact would be basically no recoveries on the loans. And the recoveries on student loans historically has been low anyway.
Okay. Thanks, John. Okay, I think Ines, this one looks like it's for you. The popularity of electric vehicles has been on the rise, especially with increased attention focused on environmental concerns. how do you see auto loans for electric vehicles impacting credit? Does DBRS Morningstar give any special consideration to these type of loans? Ines?
Yep, sure, thanks. So we're closely monitoring this subsector. There has been a lot of interest in EVs to date, and we have seen, however, we have not seen that translate into sizable concentrations in the transactions we rated. EVs tend to be a higher price point currently than the obligor base in the majority of the transactions we rate that are more subprime, and obligors are around the $25,000 to $30,000 range in vehicle prices, while EVs are substantially higher than that. Although the interest and demand for EVs is high, the true costs in terms of environmental costs associated with building and discarding of batteries, as well as the cost and availability of charging, it still makes the vehicles a bit unattainable and unaffordable for a lot of the obligors and subprime, but we are monitoring that, and as prices, fluctuate and the price of all cars basically increase, that may shift. There have been a couple of all EV deals, but we have not rated those. The biggest issue for us is the fact that vehicle values for EVs is still limited, so it's difficult for us to gauge how we should come up with assumptions on those specifically versus the traditional combustion engines. So although we're looking at that, we haven't rated anything with substantial EVs in them quite yet.
Thank you, Ines. Looks like there's another student loan one. John, does the Biden student loans forgiveness program affect this data?
I'm not 100% sure what this relates to, but I think it has to do with public service loan forgiveness, and that applies to direct loans, but that also affects FFELP loans, and I'll touch upon that. I'll also touch upon generally student loan forgiveness, because that's been a hot topic recently. So in the past, FFELP loans were not eligible for loan forgiveness through the Public Service Loan Forgiveness Program, which requires borrowers to make payments for a certain number of years on the plan, 120 months. With Public Service Loan Forgiveness, after 10 years, student loan debt is wiped out for borrowers who are in public service careers such as teaching or law enforcement, firefighting. Only direct loans qualified, so FFELP borrowers had to consolidate their loans into a direct consolidation loan if they wanted to pursue forgiveness. And as a result, many borrowers had to start from scratch with their repayment timeline. So for example, even if a borrower had been making payments on FFELP loans for 10 years, they would have to make another 10 years of payments to be eligible for public service loan forgiveness after consolidating. However, the Department of Education recently instituted new temporary rules with the program. Now, any payments made while working under a qualifying employer will retroactively count towards public service loan forgiveness, even if the borrower had a FFELP loan while making those payments. So to qualify, borrowers have to consolidate their FFELP loans into a direct loan by October, I think it's the end of October 31st of this year. And I haven't seen the latest prepay data on FFELP, but I should be receiving it over the next week or so. But I have had conversations with some of the bankers recently, and they said that some of the issuers are actually seeing prepayments increase. One issuer is seeing prepayments about double of what it has been because of, and I think they're attributing this to this consolidation to get loan forgiveness. So that could actually be a good thing for deals that we rate, as like I mentioned, the slow repayment speeds have been an issue. I think generally student loan forgiveness or student loan debt cancellation, it's something we hear a lot about. So we get questions about it all the time. I highly doubt that there'll be a wide scale student loan debt cancellation or forgiveness. There just isn't enough congressional support for this. There's no current mainstream legislative or executive plan to cancel student loan debt. And if it were to occur, however, it's unknown how much will be forgiven or who will benefit or qualify or which types of student loans might be canceled. 10,000 is an amount that's been tossed around for a while, or at least that's what Joe Biden advocated for when he was campaigning. I think if forgiveness is only applied to federal held loans, so those are the direct loans on the US government's balance sheet, not in securitizations, then I think that could be a positive for private student loan transactions. And that's because, like I said, private student loans are typically taken after federal loans are exhausted. So that would mean that private student loan borrowers will be better able to afford their private student loans. And I think if FFELP loans are forgiven, that could be a good thing for outstanding FFELP ABS deals. This is because the slower than expected repayment speed issue. So to the extent that forgiveness is applied as a prepayment to the trust, then that would increase speeds. And the amount forgiven will influence this. So for example, the average FFELP balance is around 15 to 20,000. So if you forgive, let's say 10,000, you'd have a much faster repayment speed than if you forgave, say, 5,000. Also, if you look at student loan performance, most defaults are borrowers that have less than 10,000 of debt. You would think it would be the opposite, that larger loan balances default more. And this is because borrowers that have dropped out of school or couldn't get a cosigner. Also, the fact that larger loan balances are typically graduate degrees, which default much less. So this would actually result in better quality pools remaining in deals after the forgiveness. But like I said, I doubt that there'll be a widespread forgiveness of student loan debt.
Thank you, John. Let me just scroll through, make sure we don't have any more. I see someone asked a question about solar. We don't currently rate solar ABS. However, we do rate PACE, Property Assessed Clean Energy. We have a stable outlook for both RPACE as well as CPACE. And we published a standalone research report on the PACE sector that's available on our DBRSMorningstar.com website. Just bear with me, make sure. I see a question about a spike in 30 plus day delinquencies, but it doesn't reference which sector. So maybe the person who typed that in could just say which sector they're interested in looking at.
I think, related to marketplace lending, some of the commentary that I mentioned was that, with the roll-off of government stimulus, reversion back to kind of pre-pandemic underwriting, I think those are the likely main drivers of 30-plus increase, since mid-2021. Obviously, market participants are monitoring this, but, as of right now, it seems to be in a reasonable range.
And I would say, and I would just add that for autos, very similar reasons, in addition to seasonality, as I mentioned, where delinquencies generally pick up at the tail end of the year as people prioritize holiday spending versus, paying down loans, but then it reverts back to more normal levels in the early parts of the year.
Ines, I'm going to keep you on the mic. I see another question that came in. Why do you think that subprime prepayment rates have been so high?
Well, we've seen an uptick, mostly because used vehicle values are so high and continue to increase. So people have been using that as an opportunity to trade up in their vehicles earlier on in their loans, as well as interest rates are low, so there's been some refiing activity as people may keep their own car, but refi that loan somewhere else at a lower cost. We have heard and have started to see some of that kind of come down to more normal levels, although they're still a bit elevated to what we've seen in prior years. We do expect that as vehicle values kind of normalize and interest rates kind of stabilize, that will probably taper off to more normal levels going forward.
Thank you, Ines. We did receive quite a few questions. Hopefully I covered all of them. I believe we addressed all the questions posed. We want to thank everyone for taking the time out of your day to join us. We hope that you found our insights to be invaluable and encourage everyone to read our latest note titled U.S. Consumer ABS 2022 Outlook, which again is linked at the bottom of your screen. This webinar is being recorded and will be available for playback should you wish to revisit any discussion points or share the replay with colleagues. You'll see on this last slide, we have our contact details. If there's a question that somehow we didn't get to or that you think of after the webinar, please feel free to reach out to any of us. Thank you again for joining us and enjoy the rest of your day.